What if I told you there's a business where customers can pay you every single month while you barely have to sell them anything? No restaurant kitchen, no food inventory, no thousands of employees, and in many cases, once the facility is built, running it can be surprisingly simple. Sounds like the perfect business, right? Not so fast. A self-storage facility can cost millions of dollars to build or buy. And if your location is wrong, your units can sit empty while your mortgage keeps running. So the real question isn't, can a storage facility make money? It's, how much money can it actually make after everything is paid? Let's break down the economics. When you buy a self-storage facility, you're not really buying boxes or storage units. You're buying real estate that produces recurring rent. Imagine a facility with hundreds of units. A customer rents a small unit for their furniture. Another stores business inventory. Someone else needs space while moving house. And every month, they keep paying. That recurring revenue is what makes the business attractive. But there's a catch. Your biggest expense usually isn't the boxes. It isn't the locks. It's the property itself, and that means location becomes everything. A storage facility needs land, and good land isn't cheap. If you're buying an existing facility, the purchase price can be substantial. If you're building from scratch, you're paying for land, construction, storage units, security systems, lighting, gates, cameras, office space, insurance, permits, and financing. Depending on the market and size, a serious facility can require a very large upfront investment, and this creates the first major risk. You can have a profitable business model sitting on an unprofitable piece of real estate. A fantastic facility in the wrong location can struggle. A basic facility in the right location can perform extremely well. Now let's look at the revenue. Suppose a facility has 500 units. If the average occupied unit generates around $100 per month, then at full occupancy that's roughly $50,000 per month. That's $600,000 a year. But here's the important part. A facility is rarely at 100% occupancy all the time. You have vacancies, customers move out, some customers don't pay, you may offer discounts to attract new renters. So let's say occupancy averages around 85%. Now your revenue is much lower. And this is why occupancy is one of the most important numbers in the entire business. Here's where self-storage gets interesting. Unlike a restaurant, you don't have to buy thousands of dollars of food every week. You don't need a huge kitchen. You don't have food and spoilage. You may not need a large staff. And many facilities can automate a huge part of the customer experience. Online reservations, automatic payments, electronic gates, security cameras. Digital access. That means one facility can potentially generate substantial recurring revenue without requiring hundreds of employees. But that doesn't mean the money goes straight into your pocket. First, there's debt. If you borrowed money to buy the facility, the lender gets paid before you. Then there's property tax, insurance, utilities, maintenance, security, cleaning, marketing, management, repairs. And eventually something always breaks. A gate stops working. A security camera fails. A roof needs repairs. A unit gets damaged. These costs may not happen every month, but when they do, they can be expensive. And then there's another problem, competition. If 3 new storage facilities open nearby, you may have to lower prices or spend more money on advertising. Let's use a simple example. Imagine our hypothetical facility generates $600,000 in annual gross rental revenue at strong occupancy. Now remove operating expenses, then remove property costs, then remove management and maintenance. And if the facility has debt, remove the loan payments too. Suddenly, that impressive $600,000 revenue number looks very different. And this is the lesson most people miss. Revenue is not profit. A facility making $600,000 a year isn't necessarily a $600,000 a year business for the owner. The real number that matters is what remains after operating costs, financing, and other expenses. So, is owning a self-storage facility worth it? It can be. The business has some powerful advantages: recurring customers, potentially low staffing requirements, multiple revenue streams, and a product people often need regardless of trends. But there's one thing you cannot escape. You need the right property, the right location, and the right numbers. because buying a storage facility isn't simply buying a building. You're buying a cash flow machine and paying millions to own the machine. If the numbers work, it can be extremely attractive. If they don't, you're just the person paying the mortgage. That's the economics of owning a self-storage facility.